Hello and welcome to Business Incorporated, live to you from Channel's television headquarters in Lagos. I am Bolaji Akinwale. Today on the show, the Nigerian Stock Exchange is to list the first company for 2016 and a look at U.S. markets for the trading week. Plus, the World Bank projects oil prices at $55 for 2017. Okay, let's begin with the story that says that Nigeria's former finance minister and managing director of the World Bank, Dr. Ngozi Okonjo Awe, is among 10 experienced and diverse group of leaders selected to be part of an advisory panel for the Asian Infrastructure Investment Bank. At its inaugural meeting in Beijing, the panel discussed the global economic situation and its implications for the bank's operations, the need to promote green infrastructure in the new global agenda, as well as the importance of increasing private sector involvement in infrastructure in the region. The panel will also be expected to provide impartial, objective, and independent advice to the president of AIIB, Jean Linkun. And the Nigerian Stock Exchange is set to have its first listing for 2016. That will be taking place next week. An indigenous company called the Initiate will list its shares on the exchange and present facts behind the listing to capital market stakeholders. The Initiate is a company which focuses on waste management, industrial cleaning, and decontamination to both the public and private sector. In the meantime, the management of Vetiver Fund Managers Limited is expected to visit the Nigerian Stock Exchange to list a Nigerian sovereign bond exchange-traded fund. This will be the first bond ETF to be listed on the stock exchange this year, giving investors access to federal government bonds in retail lots. This will provide an opportunity for every Nigerian to invest in federal government bonds. And to Europe, where stocks were higher on Friday after the European Central Bank cancelled talks regarding its future monetary policy, sending the euro to its lowest point since March and dampening risk appetite. Janelle Dubalong is DWTV financial correspondent, and she joins me from the Frankfurt Stock Exchange. Janelle, it's great to have you on this Friday. Now, talk to us about the European Central Bank stance on its monetary policy, which include its quantitative easing program. The market seems to embrace the ECB's decision not to discuss tapering of the bank's 1.7 trillion euros asset purchase program in the near term.
Hi. Yes, broadly speaking, markets in Europe did close higher after the ECB's remarks. So although in the end, it's mostly because of the lack of change, investors and traders were mostly hearing the message that everything is to remain the same policy-wise, but come back in December for some more decisive policy action where we will also have fresher economic data and forecasts to go by. So that's left a lot of doors open for now and a lot of possibilities, which can be quite positive. On the other hand, it's also left a lot of questions unanswered. So Draghi, for example, said yesterday that the extension of the quantitative easing program beyond March 2017 was not discussed. Although, of course, this is something that's widely expected in the market. Many people are forecasting that this will happen. And if it does, traders and investors would have wanted some more signals on how the ECB would address the potential problem of bond scarcity, whether it would even have enough bonds to buy if the QE program goes on for longer. And if it were to address this problem, does that mean that they would tweak the kind of bonds that they're allowed to buy in order to allow them a greater pool? So that wasn't discussed. As you also mentioned, tapering wasn't discussed as well, which of course would calm the market, would calm investors for now, but also leave them without a clear idea of how the ECB plans to exit these stimulus measures, which of course they themselves have said cannot go on forever. So in the end, the investors have not panicked, but there is certainly still some nervousness or some uncertainty regarding the ECB's plans.
Now, while there was a positive reaction from the stock markets as regards the ECB easing program, the euro reacted negatively. Why this reaction?
Well, I think a lot of factors are at play here, and this volatility sort of speaks to the very fragile tightrope that Mario Draghi is trying to walk. On the one hand, he was trying to be reassuring by saying that the stimulus program won't come to an abrupt end, although tapering a gradual end has not yet been discussed. On the other hand, he was saying stimulus can't go on forever, as we said earlier. So the euro was probably priced for him to be more dovish, and this up and down reaction happened as investors wrestled with what it was that Draghi was really trying to tell them. And of course, the other factor is the strong dollar. We've seen a surge in the dollar, and that has dragged down the euro. And this surge in the dollar is, of course, driven by expectations that the Federal Reserve will increase the rate in December, and that, of course, is a total policy divergence from the European Central Bank's continued stimulus measures. So that's what we have going on there.
It's the final trading day, and more earnings are still coming in. We have Intercontinental Hotel Group and Daimler releasing the numbers. Tell us more about this.
Well, both of them were kind of patchy. With regard to Intercontinental Hotel Group's third quarter revenue, we have their third quarter comparable revenue per available room, or RevPAR as it's known in industry parlance, and we saw it grow by 1.3%, which means that it only grew 1.8% in the first 9 months of the year, down from 2% in the first half. Still, the hotel group is quite confident about its outlook. Now, I can't say the same for Daimler. Now, Daimler's net profits increased by 13% to a record 2.7 billion euros compared to the same period last year. So that would be some good news, right? But on the other hand, they have had to lower their sales forecast because of weakening demand from North America. And that it's on that news that Daimler's share price actually slipped more than 2% in trading here today at the DAX. Investors were not at all happy to hear this. But what actually happened there was something we call profit taking. That's when investors sell off stock that had been rising in order to lock in the gains before a perceived future drop, as risk factors loom for Daimler, like its weakening truck business, like increasing price competition in Europe. So basically what investors were doing, safe.
Thank you so much, Janelle Jumalong, DWTV financial correspondent, reporting from Frankfurt. Still from the markets, this time in Asia, where the numbers were lower across the board, while investors and traders digest data showing China's home prices climb, and as a typhoon shut down the Hong Kong market and caused casualties and destruction in the Philippines, and an earthquake struck in Japan. In Japan, the Nikkei closed down 50.91 points following a report of a magnitude 6.6 earthquake that struck western Japan. Reports said a tsunami warning was not issued. And to the U.S. market, where it's been a busy week for traders, with earnings season in full swing and the national election just weeks away. With more details on what is moving the markets, here is Jill Maladrino, business correspondent from VOA, joining us live from New York City. Jill, it's good to have you on the show.
Hi, good morning. So I'll give you a quick recap of what's happening with the elections, which has really been the big news of the week after digesting the third and final debate on Wednesday night. And all I can say is, wow, just yesterday Donald Trump held a rally and said he will accept the results of the election if he wins, but will reserve his right to legally challenge the results if he loses. Honestly, you cannot make up what has transpired in this election season. This truly is a case where reality is more interesting than fiction. But let's look at some hard data that one of my favorite research firms, Bespoke, has compiled to back up how crazy this really has been. In Bespoke's September survey, the most commonly used word to describe Trump was idiot at 4%. The most common word used to describe Clinton was liar at a whopping 15%. This month, with a completely new set of survey takers, the top word used to describe each candidate stayed the same. Once again, 4% of survey takers described Trump as an idiot, while 17% of survey takers described Clinton as a liar, which is a 2 percentage point increase from last month. Overall, a large majority of responses were negative, which says a lot about the state of this election. With these kinds of numbers, whoever wins is going to have a really tough time winning over the public once they take office.
It's quite obvious that American voters now are very sensitive and are dissatisfied with both candidates. How do you think the markets will react?
Well, some analysts do not expect the markets to be affected just from the results alone. Historically, despite the very short-term risk of volatility and the potential policy uncertainties, the likely long-term outcome of the election is continued economic growth and consequent market gains. But this is why Africans should care. As you know, I hosted a series of interviews at the NASDAQ market site for the Africa Investor Summit. Our theme there was aid to trade to institutional investment. This was in conjunction with the second annual Bloomberg Philanthropic Conference at the UN, where President Barack Obama spoke in support of U.S. investment on the continent and with Africa and the U.S. No administration has done more to move trade and investment to the forefront of the U.S. engagement in Africa than the current one through President Clinton's Africa Growth and Opportunity Act, and this will be part of Obama's legacy. I would expect a Hillary Clinton win to carry out this path, but the exact opposite if Donald Trump wins, because he is a severe protectionist and may not be quite as accommodating to international and investment.
Now, Jill, before I let you go, in addition to the election, 11 Dow components reported earnings this week. Tell us more about this.
That's right, and nearly 20% of the S&P 500 reported, of which those 11 Dow components are a part of. Most of the spotlight was on Netflix earnings. The numbers were strong, and that lended to strength in what U.S. traders call the FANG stocks: Facebook, Amazon, Google, and Netflix. Overall earnings season, which began back on October 11th, the average stock that has reported earnings has gained about 1% on its earning reaction day. While it's still very early in this quarter's reporting period, so far investors have been buyers instead of sellers on earnings news.
Jill Malandrino, VOA business correspondent from New York. Thank you so much for your perspectives. Now, British American Tobacco is planning to merge with its U.S. partner Reynolds in a deal valued at $47 billion. That's an equivalent of 38 billion pounds. BAT wants to buy the 57.8% of Reynolds it does not already own. The merger will bring together some of the tobacco industry's best-known brands, including Lucky Strike, Rothmans, Dunhill, and Camel cigarettes. BAT has been a shareholder in Reynolds since 2004. And the company says that the merger will be, was the logical progression in their relationship. The FTSE 100 company is offering $20 billion in cash and $27 billion in shares for the U.S. business. BAT estimates that it can make $400 million worth of cost savings through the merger, which includes assets such as Reynolds' production facility in Tobaccoville, North Carolina. Now let's take you to the local fixed income markets as we have you joining me on the show, Ifeanyi Akweche, who is a fixed income dealer with Wema Bank, talking about how the market has been for the last trading day of the week. Ifeanyi, thank you so much for joining us on the program.
Yes, thank you. Good afternoon.
Good afternoon. Tell us how the market is doing. Today is the last trading day. It's been a very eventful week for the fixed income market. During the week, we saw how we had twin auctions from the DMO. We also had from the central bank. How are the numbers doing at the moment?
The fixed income market is today not been very active. Just like you mentioned, there were a lot of activities over the week. For today, the bond market has been quite low. There have not been any transactions in the bond market today. But for the T-bills market, we expect some further sell down as some people are still trying to cover their position for the FX funding for the week, as you mentioned earlier. So we don't expect the trend like this to continue until like next week. So we're expecting some inflows into the market, but for today, it's been very low in activities.
All right, thank you so much, Ifeanyi Akweche, a fixed income dealer with Wema Bank. Do enjoy the rest of your day. We'll go on a break. I'll be right back.